Hello everyone, it's Alpesh here. Sorry for giving you waiting a couple of minutes. I'm still getting used to all this technology. I don't mean the internet, I mean webinars and so on. Now, as I said, this is a repeat of my March the 6th seminar. Obviously what I'm going to say is going to be slightly different to what I said then, because it's a whole week that's gone by, or slightly more than a week. But what I wanted to do was repeat it, partly for those who want to hear it all over again, partly because we actually had reached capacity and couldn't take on more people, which is a proud thing for me to say. So let me kick off. As you can see here, we're going to starting open screen there, and through alpeshpatel.com I offer FX videos all free and FX webinars, as you can see here. And what I love about webinars is that you can be sort of done within the hour, and you know, it means that I can do it, as I say, free of my time, whereas normally if somebody said, can you do a talk on FX, it used to take up, you know, a good 3-4 hours just for a 1-hour talk. So I think everybody wins. So I wanted to highlight alpeshpatel.com to you for that reason, that we've got all this stuff and you can just go to that site. And as you can see, a screen grab from that site shows you some of the upcoming webinars. So as I say, if you go to alpeshpatel.com /webinars, all of these are free, so you'll be able to get into a whole load more. And in fact, everybody should have received and will receive, again, after this webinar, a list of all the forthcoming webinars on foreign exchange trading strategies, advanced strategies, and a beginner's guide, everything that you'd want in simple terms. And this will be being recorded, and you'll be being sent a link of this as well. So let me go through, without any more waiting, to get into FX in 2012, some of the big bank views, and as I said, some of the future webinars. And I want to discuss in particular who makes money and some of the things like the strategies used by the winners. That we'll have dedicated webinars for those, but I'm going to just touch upon it for this one to add a bit of spice and really useful information, because ultimately what you really want to know is which of the FX traders who are making money. And what we've got is data from real investors, not the world's greatest hedge fund managers, but actually people like you and me who are real people, private investors who are trading whilst maybe doing something else as a day job or whatever else. And the reason that we wanted to take that data rather than just what some of the, you know, what George Soros advises, is because it's more relevant to us. So I'm going to touch upon some of those things, not just give you my forecast in FX, but actually tell you of all the private investors that we've analyzed in their trades. And we've been able to do this because we've got access to a brokerage, broken down their trades, for instance, by what time of day in certain currencies private investors tend to make money, in what currencies they're more likely to make money. And we've got this based on hard data, not just our gut feeling and so on. I'm going to share some of that data with you as well, which I find really exciting, because nobody else has, as far as I've seen, got access to this kind of information, and I think it's very useful, and private investors should have it so they can do the same thing. But we'll get to that in a second. I'm just teasing you with it for now. And of course I will give you not just my predictions for where I think foreign exchange markets are going in 2012, so you can trade off those, but also what some of the big banks like Goldman Sachs and so on think, just in case you don't think my views are as good as Goldman Sachs is, or vice versa. That's why I better give you mine as well as theirs. First and foremost, I've got to give you, and these are not just disclaimers for legal reasons, they actually really do matter. And they matter in this regard. I'm going to mention a whole load of securities and so on, and who knows, tomorrow morning I might place some of the trades on sterling dollar. Now, I can't move the markets when it comes to sterling dollar, because there's about $2 trillion worth of trade going on every day. But people should be aware I might be doing any of these positions that I discuss, even though the fact of the matter is I won't be able to move the market, neither will any of you through your individual trades, although I noticed George Soros has just signed up for the webinar, so maybe I'm wrong, maybe one of you at least will be able to move the market. I also want to mention, because we'll be mentioning spread trading as well as just normal regular Forex trading, so I'm going to talk about all the products. You should be aware of the risks involved with each of those types of products. I don't want you to think I'm just throwing out products without care or concern for the fact that these are leverage products, and you've heard the warnings before, these things may go up as well as down. Well, actually, these are actually serious warnings because people do, in reality, lose money. And I don't want you to think that, oh, everybody's going to have a private jet and their own desert island. Some of us might have to settle for yachts, unfortunately. The next thing is, as I mentioned, foreign exchange on margin. All of this carries a lot of risk. Now, obviously, in this webinar and the other webinars, our job is to make sure you understand how to mitigate the risks through some of the rules and some of the techniques that other private investors themselves have learned. And that's what we're going to do as we go through these webinars. I noticed that we're getting more attendees as I'm speaking. Obviously, either the word is spreading or some people are just a little bit late. Don't worry if you are late. We haven't really kicked off into the meat of things at the moment. In case you don't know who I am and you've stumbled across this purely by accident on an evening, those companies that you see listed are some of the clients of my company, TraderMind Limited, and the others are some of my books, he says, moving backwards to those. So those are paying clients, I should say, past and present paying clients. Gives you a bit of idea of my credentials. I've also been on Newsnight. I mean, surely that's the most important thing to justify anybody's Forex credentials. And I was indeed sneered at by Paxo, and that's just a picture of me before I get up to hit him. Now, getting into some of the serious meat of stuff. My job in this webinar and all the other webinars going forward is basically to distill this type of information. My job isn't to make you the governor of the Bank of England, isn't to make you an economist, and because I don't think you want to be either governor of Bank of England or economist. I think you want me and the information I'm going to give you to have distilled things like what the current account balance trend is having on exchange rates, what international reserve diversification is having, or GDP growth, and all of this. But you don't want me to give you long lectures on each of these because we're not in a university, we're not in a classroom. Our job is to be practical and, most importantly, look to make money. That being the case, I want you to know these are just some of the things that I look through. In actual fact, I am going to be giving courses on all of this stuff, but those courses are going to take about 28 weeks and they haven't yet quite been finished. So if you did want to become a professor of economics or an investment management guru, then that's not a problem either, but it's not the place here. I just want you to know this is kind of some of the information that we look at when we come up with forecasts, but I'm just giving you, in effect, the conclusions and the directions of the trades. It's a little bit like you can enjoy television without understanding how it works. Well, my job is to make sure you enjoy the foreign exchange markets with a little bit of knowledge about how they work, but if we wanted more knowledge, I want you to be comfortable that I have indeed, as of the banks whose forecast I'm going to give you, gone through all of this kind of information. So let's move on. First things first, the thing that, for instance, when I do the BBC newspaper reviews twice a month, I'm asked about more than anything, is Greece and the effect on the euro. I had lunch 2 days ago with the chairman of Goldman Sachs Asset Management, Jim O'Neill. You might have heard of him. And I can tell you, Jim and I agree on one thing. Well, we both agree he gets paid a hell of a lot more than I do. The other thing he and I agree on is that Greece is irrelevant. It's irrelevant to your economic well-being. It might not feel like it, and certainly for some of my Greek friends who are listening, I apologize, but your country is irrelevant in the bigger scheme of things and irrelevant in that I don't want us to be worrying about it when we're looking at foreign exchange trade, and I'll explain why. I'm going to give you the big overview first before I give you actual specific trades. So we're starting at the helicopter view and we're going to drill downwards. Reason Greece is irrelevant to all the things that we're going to look at, all the currencies, is first of all global GDP. $14 trillion is how much the United States produces annually. That's even if they don't have any growth. All this worry about, oh, there might not be growth in America. Even if there's not growth in America, $14 trillion of goods and services are produced by hardworking and some not so hardworking Americans. In Europe, in the euro area, so that's excluding the United Kingdom, for instance, you've got some $12 trillion. Once you put in the UK, then the EU is about the size of the United States in terms of GDP and population. 250 million people, $14 trillion worth of goods and services. Between the United States and America, you have the world's two largest trading blocks. Then shove in a bit of China at 10% growth per annum, although they've recently said 7.5%. Japan, which we all forget about, despite them having anemic growth for the last 10 years, actually going on to 20 years. That is still a $6 trillion economy. Added to China's $6 trillion, and you put those two together and you've got the euro area in terms of growth. So overall, in terms of the broader markets, I really am not that worried about any currencies falling out of bed or the euro going to zero or being disintegrated and destroyed and so on. So I just want to give a context. Now, the reason this is important is because when we're talking about foreign exchange trades and my outlook for 2012, if I seriously thought the world is about to come to an end or the Eurozone is disintegrating, then all bets would be off. I just could not predict for 2012. I could not give you forecasts because the big unforeseen things would be in place. What I'm saying is they're not, and they're not something I need to worry about. We put it in slightly different terms. This is a map you'll recognize of the United States, and each of the states in the US are marked by their equivalent foreign countries by GDP. Italy, and you're going to hear about Italy a lot in the news over the coming months because the fear is it's the next Greece and will require huge bailouts and so on. Italy has the same GDP as California. California, coincidentally, like Italy, has been on the brink of bankruptcy probably since the 1970s. Well, it feels like it's certainly since Arnold Schwarzenegger became governor. Regardless, whatever the case is, Italy and California are about the same GDP. California was at one time the fourth largest economy in the world. It was the size of France. It's still the size of Italy. No mean feat. You don't hear about people when California has its crisis and unbalanced budget and having to call up for state aid from the United States of America, people saying, well, the Californians are going to have their own currency and drop out of the Union, or that the United States is about to crash and burn. No, the US, $14 trillion economy, like the EU. It, like the EU, has an Italy, and yet seems to survive perfectly well. This is why I want to put it into context. By the way, that's Greece. Greece is the same as Washington State in the United States. If Washington State had a fiscal crisis the way Greece has had, you really would not hear it in UK news. Actually, you wouldn't probably even hear it in American news, but that's just a reflection of how bad American news is. Nevertheless, my point is I'm not worried about foreign exchange markets being increasingly volatile in 2012. That's good, because as I'm going to show you, we found private investors make more money during less volatile markets, because they're not wrong-footed, than they do in more volatile markets. So I wanted to set that overview first and foremost. So now let's move on to exactly that point, volatility. What we're noticing, and this is from Bloomberg, is that volatility is down. This is partly as a result, and again, you don't need to worry too much as to why, but partly because of central bank policy, low interest rates, quantitative easing, and so on. What tends to happen when market volatility is down is that people buy currencies in which they're going to get higher interest rates. So it's like putting your money in a bank account which pays more interest than one which doesn't. Well, bank accounts in Norwegian kroner, for instance, and in New Zealand dollars tend to pay higher rates of interest because they're commodity currencies. They're currencies in which their countries rely heavily on commodities like Norwegian oil or, in the case of New Zealand, sheep. No, tell a lie, of course, New Zealand got much more than sheep to offer in terms of commodities. They pay greater rates of interest to control inflation and their increased growth levels than, for instance, those currencies which have been deploying quantitative easing to drive down interest rates, which are the United States dollar, the euro, and the Japanese yen. So what happens when the markets are not volatile is people just put their money in one set of bank accounts versus the other. In other words, they go short and because they expect it to fall the dollar, the euro, and the yen, and they go long the Norwegian kroner and the New Zealand dollar. What that also is telling us is two things. First of all, it's telling us a broad direction of trades for the year in very broad terms, but we'll look at specifics later, which is short dollar, short euro, short yen, and it's also telling us, interestingly, it's not short euro because of the European crisis, it's because interest rates are low. It's also telling us long these two currencies, well, these three currencies, these two currencies. I believe that actually should be Australian dollar, it should be AUD. Anyway, the point is that the reason you're willing to take the risk of having a foreign currency like the Norwegian krone and the New Zealand dollar, let's say you live in Britain and you want your money in pounds, the reason is because you don't expect volatility to be high, and so you expect by the time you convert it back, you won't have lost out on the exchange rate having changed. So lower volatility means people go for interest rate plays. Interest rate plays, had you done that, or what's called a carry trade, the difference between interest rates in one set of currencies as opposed to the other, the carry trade, this is what it would have returned you from just the last 3 months. You would basically have made about a 7% return in just 3 months. The important thing here is volatility is down, which is good for private investors, as I said, because when volatility is down, private investors, as I will show you, statistically make more money than professional investors, or they get a better chance than they normally do against professionals. But also, it means that we want to be looking at a bias for 2012 of shorting dollar, euro, yen, and a bias of going long the krona and the New Zealand dollar. Let me move on. What do I think is going to happen this year? Well, first of all, I certainly think that the US dollar is likely to trend lower. This is despite, obviously, what's happened over the past week with non-farm payroll figures. I don't want you to mistake the long term with the short term. What will end up happening is the US dollar will trend lower, partly because of quantitative easing, partly because of the rally it's had against most currencies, except the euro and the yen. And the reason for that is all three have very low interest rates. So the dollar, except these two, will trend lower as people undertake the carry trade and go for greater interest rates. I also think the Canadian dollar, this is just an overview, I will go into detail later. The Canadian dollar, I'm bullish. It's a AAA rated country, unlike the United States, and also what tends to happen if the dollar is weak, you would expect the Canadian dollar also to be weak, but remember that the Canadians are an oil-rich country and it's a commodity play and will probably start raising interest rates before the Americans. And so I'm more bullish the Canadian dollar. The euro rally, which has happened, probably means we're not going to see another bull story for the euro, even though we're going to get all excited that the Greece problem is resolved for now and so on. I actually think the market so anticipated this, we're not going to get a euro rally again this year. And I've already mentioned interest rate being low in Europe is another reason to be short the euro. I expect the euro to fall against the yen, again because the differential between the two, which means that people are no longer willing to stay in the euro in order, because the low differential, in order to take advantage of any interest rate. Sterling, supported by AAA rating and by not being the euros, I'm quite, well, at worst I'm neutral on sterling, at best I'm bullish. Asian currencies I've already mentioned, they're commodity plays, their countries are having good growth, which is another reason why people will buy their currencies, and their interest rates will start rising. We're talking exception of Japan, because it doesn't really count as a growth or emerging economy in Asia. It's already emerged, and I expect those currencies to be appreciating. We'll have to look at specific trades, but these are my overall biases, let me put it that way. The dangers to anything that I've said, and everything that I've already said, is that China could have a hard landing. Now, when I spoke to Jim O'Neill, as say, chairman of Goldman Sachs Asset Management, he'd just come back from China, and he'd said, you know, for those people who were surprised when the Chinese said we're only going to have 7.5% growth, those people should not have been surprised, because the Chinese have made it absolutely clear they don't want to continue at 10% growth, because it leads to bottlenecks, it leads to inflation, it leads to, therefore, social unrest. They do actually want to rein back growth to a more manageable level so infrastructure can catch up, so prices and earnings can catch up and doesn't lead to social upheaval. So 7.5% is exactly as they'd intended. It's not a danger of a hard landing. A hard landing would be if growth went down to, say, 5% or 4%. The Chinese, he said, and I agree, are very good at managing their economy. The other danger is the euro could be far worse than we've said. Everything that I've said, I could be completely wrong on. The Greeks issue, the Spanish, the Italian, I just don't see it supported by the facts. I don't see it supported by Goldman Sachs, for instance, who agree with what I've said, or vice versa. Finally, there could be a very sharp oil spike. Again, let me tell you what my lunch at Goldman's revealed. I'm not just here to repeat what Goldman's has said. It's just data and statistics which the city knows, which very often private investors don't. And I can certainly tell you BBC journalists very often don't broadcast, or CNBC or ITV or whoever else the broadcaster is. And one thing's clear. He said if somebody put a gun to his head and asked him if in 5 years oil will be closer to $150 or $50, he said it'll be closer to $50. And the reason for that is the massive search for alternative energy. So you could, of course, in the short term have a spike in oil because of global conflict. The Israelis decide to bomb Israel, which he doesn't see as likely, and I'm afraid I don't either. Therefore, I just don't see a sharp oil spike. And I think those contrarians and those pessimists who are expecting it are going to be sorely disappointed with that. Now, of course, if oil went up 10, 20%, that's fine. Our currencies remain largely non-volatile as a result. We're talking about a spike which takes it well beyond 150. Don't see that happening. This is to give you a context against which I'm making the forecast for 2012. It's an important context because our trades are going to be based against that background. So let me first and foremost actually give you an example of the kinds of trading strategies I tend to deploy. And then I'll get into some specific forecasts. Now, I'm going to have separate webinars on trading strategies for foreign exchange, but at the moment I just want to give you a very brief example. As I said, this video is going to be available. We'll email you the link, and we'll email you an invitation to my blog, so each day you get a free update on what I think is happening in the market straight into your inbox as well. So I don't want you to worry if I go too quickly. So we're looking at euro dollar. Each one of these bars represents 1 minute. So that's the high point at the top of each bar, and at the bottom is the low point for that minute. We happen to know, this happened last week, that at 10 o'clock, 10 a.m. UK time, Eurozone GDP data would be being released. Now, I will look to see when highly important economic data affecting either the yen or sterling or the euro, basically the major currencies, is going to be released. Now, you'll ask me, well, wait a minute, how do you know when it's going to be released? How do you know it's important? Luckily, there's lots of free websites which will tell you this. For instance, one that I use, it's completely free, dailyfx.com, but there's others. It has an economic calendar. It tells you what time the release is and whether it's high, medium, or low importance. The reason I want to know whether it's high importance is because high importance economic events will move currencies, and we want them to move so that we can place a trade. So I happen to know that at 10 o'clock, Eurozone GDP data would be out. I don't try to interpret whether it's going to beat expectations or not. You know, that's what the pundits do. It's what the people who don't trade the darn thing do. All that matters when you're going to trade this data is what happens to the price. And in this case, what happened to the price is shown by the graphs. The first thing I look to do is, regardless of whether the data is above, below expectations, or whatever, is I look to see what happens in that first minute. And you'll see at 10 o'clock, in that first minute after the data, euro data was out, and I picked euro dollar to trade, the market fell a little bit, not much. What I tend to do, if in the first minute it's fallen, I will then look to go short, in other words, sell, hit the sell button, if the price falls below that first minute's low point. So I wait for the second minute, which is this bar, and if it falls below the low of the first minute, I sell. And vice versa if it went the other way. But let's just focus on what's actually happened here. And so you sell. And as you can see, as the minutes pass, the price keeps on falling. In fact, it fell for about 20 odd minutes. So you had ample time to trade off the economic data. Sometimes people say, oh, you can't trade economic data. It immediately goes to where the price should be. And actually, that doesn't. It takes a long time to do it. So I don't care what sorry, I spelled weather incorrectly in the slide, but I don't care what the actual data says. I care what the price does. And we look to sell. Now, you might say to me, well, how do you know when to get out of the trade? How do you know when to buy to get out? What tends to happen in the cut and thrust of trading when you're doing this is, if the price is moving in my direction and I'm making a profit when I've just sold, I might increase my trade and sell some more, sell a bit more, sell a bit more, because it's going in my favor. If it starts moving against me and I notice that I just sold a whole load, let's say at 13165, and oops, I'm in a loss, it seems to be going against me, then I might get rid of that and take a very small loss. And as it starts moving against me and my profits that I've incurred start decreasing a bit, I'll start taking those profits. If you want a more strict and formal rule than that, then simply, well, if I'm making profits, I'll keep on adding to my positions, and as soon as I see some of those profits diminishing because the price moves against me, I start closing them out, closing them out. What I would suggest is you exit if the price makes the highest it's been, either for one whole minute, which in this case would have been around 9 minutes past 10, where it's made a high point compared to the previous minute, or you sell a third of it if it makes a 1 minute high, and the next third if it makes a 2 minute high, the highest it's been for 2 minutes, and the final third if it's the highest it's been for 3 minutes, for instance. So you would have probably exited some of your position at about 9 minutes past 10, because that's a 1 minute high, the highest the price has been over the preceding minute. A 2 minute high seems to have occurred actually not at 13 minutes past 10, but a 2 minute high seems to have occurred at 18 minutes past 10, and a 3 minute high, the highest the price has been for the previous 3 minutes, seems to have occurred at 24 minutes past 10. So that's quite a nice profit to have got in. You've got in at 131.85, so let's just say at 85 you sold, or thereabouts. Let's even say you sold at 80. Those are the last two digits. And you bought back at, an average of around 55 or 50, even 45 in some cases. And that's just off trading for 20 odd minutes or 25 minutes. Not bad in terms of, depending on how much money you put into those trades, for 30 minutes work. You probably sneak out if you've got a day job to the loo and do it instead of looking at Facebook or whatever people do in jobs. In all seriousness, it's a trading strategy. I'll discuss more of these in separate webinars, but I just want to give you an outline of the kinds of things I look at. And what I wanted to also get across to you is also that essentially these data can only do one of five things. Either they come in well below expectations, well above, or within. In actual fact, as I said, it doesn't matter. You don't need to be an economist. You just look at what the price does. That's all that matters. And if somebody asked me what happened with GDP, Euro GDP, was it within expectations, above, below, well above? I don't know. I don't care. Somebody asked me what the euro-dollar rate is. I couldn't tell you. I could probably tell you what the last two digits were, but I couldn't tell you what the figure was, whether it's 135.80 or whatever it could have been, because I'm not looking at that, and I don't care what those major figures are. I'm just looking to trade it. Well, buy high, sell even higher, or sell high, buy low, or buy low, sell high. Whichever I do first doesn't matter either, as long as I'm buying lower than I'm selling. So let's continue in this vein to some of the other data. Now, there's a lot of data out there. Don't worry about reading all of this. You don't even need to read it. You don't even need to understand unemployment. All you need to know is, when is the data out and is it of high importance? Well, I've already told you, websites give you that information. So in the case of Australian employment data, and this is just from the last broadcast I did, these are some of the decisions which have come out. My point is, there's a heck of a lot of information that comes out which affects interest rates. So it's not just once a week you're going to be able to do a 30-minute trade in foreign exchange. It's going to be probably about 30 minutes every day. There's going to be something in one of the various currencies. So it might be the Canadian dollar, the US dollar, the yen, the euro, and that means that you're going to every day at least, and just over 30 minutes, be able to do this. Now, let me, again, before I give you the actual trades and what things I think direction is going, let me show you this slide. It's a very important slide. A broker, in this case FXCM, looked at 12 million trades that their private investors had placed. 12 million of them. Then, having looked at those 12 million, they worked out in which currency pairs do those private investors make the most money. Actually, the first thing they looked at is what are the percentage winning trades and the percentage losing trades. And what they discovered in Australian dollar, New Zealand dollar, in the Australian dollar, New Zealand dollar trades, 71% of private investor trades, people like you and me, were winning. They were winning trades, 71%. So if you said to me, Alpesh, what currency should I trade? I'd say, you know what, the odds are in favour that you should trade the Australian dollar, New Zealand dollar, because you've got a 71% of being right, and only a 29% probably of being low. And if you said to me, Alpesh, which currency should I avoid? I'd say, you might want to reconsider Australian dollar, Japanese yen, because chances are you're not going to have a winning trade on. Now, in a future webinar, I'll go into more details, who wins, who loses, and why, and what are they doing. But I just wanted to show you this, because I think it's mentally important when you're picking your currency. But, remember what I said? I said this is the percentage of winning trades and the percentage of losing trades. It's not the amount of money made, it's just how often you're going to be right or wrong. How often you're right or wrong doesn't matter. What matters is whether you make money or not. I want you to remember, just as we move forward, most private investors lost money, i.e. 49% were winning trades. 51% of trades placed in Australian dollar, Japanese yen, were losing trades. Just remember that as we go forward into the next slide. What this slide shows, again, 12 million trades, was the average profit and loss for private investors such as yourself, the average profit and the average loss in every single currency traded. So if you said to me, Alpesh, in which one am I likely not to be right the most times, but actually most likely to make money, in other words, where the blue bar is greater than the red bar, I'd say to you, my friend, and you might think, Alpesh, this is a bit odd, you're trying to encourage people to foreign exchange trade, and you're showing me a bar where in no single currency do private investors actually make money. They make more profit than losses. Well, obviously, I'm saying this is because I've only just started my webinars. Had they all taken these, they would have been profit. So what happens when you haven't been taking the webinars? Well, actually, you're most likely to make a profit in Australian dollar, Japanese yen. Look, 60 pips is the average profit, 63 pips is the average. You're still losing money, but you're getting darn close to making profit. On average, Forex traders, private investors, lose, on average, virtually twice as much as they make. And they're worst off in trading euro-dollar. Look at that, 65 to 127. Pretty bad. That's the one I'd probably say to you, you know what, you better stay away from that a bit. And I'd say you might want to focus on Australian dollar, Japanese yen. But remember Australian dollar, Japanese yen? Look at that, Australian dollar, Japanese yen. You're most likely to be wrong on Australian dollar, Japanese yen, yet you're most likely to make money or come closest to being profitable. Well, how's that? How can you be right as often as you're wrong and still be closer? Well, I'll go into how that works in reality, as I said, in future webinars. You can sign up for them, they're all free. You can sign up for them, who makes money and who doesn't, and I'll go into more detail in those. But the purpose of this one is to give you an idea of which currencies in 2012 you might want to focus on, why they lose and who actually wins, and what strategies they use. I'll tell you, as I say, in one of the other webinars as well. As I say, I keep repeating because I'm really proud of the fact that they're all free. So I'll tell you that we'll go into more detail there. But for now, I want to just go into what I think is happening in terms of broader markets and direction. So let's turn in the final 20 minutes of this webinar in some of the charts where I think the markets are going and where people, as I said, like Goldman Sachs and so on, think the markets are going as well. Sterling, New Zealand dollar. Essentially, I think, and I look at the MACD, and again, it's something which, for those who don't know MACD and technical indicators, we're going to give some free webinars on that as well. But momentum is going upwards, and I expect this to be a long trade. In other words, buy. In other words, it's going up. So from 1.9, it's going to go up to 2, 2 being a recent resistance level. So I'm bullish on the sterling New Zealand dollar trade. If your mind works in these ways, what that essentially means is I'm saying that in this instance the New Zealand dollar will be weakening. Now you'll know I said earlier on, fundamentally you're looking to go into commodity related currencies like the New Zealand dollar because of higher interest rates. All I'm telling you is on technicals, based on chart, up till May, I'd be having a bullish bias on this. I'm expecting the New Zealand dollar against sterling to weaken. Why did I mention the New Zealand dollar and sterling and not other currencies? Well, I'll be going through other currencies, but I'm trying to give you some of the ones where I think the picture is the clearest, where I think the odds are the most in your favor of a particular trade. What I'm noticing in the euro New Zealand dollar, however, is I'm not seeing the New Zealand dollar weaken. In other words, I'm not seeing this price go higher much because I'm just not getting the follow-through despite the momentum coming through. Now, as I review this, I'm going to do a monthly webinar of my monthly outlook at the end of each month or the very near the start of each month, where I look at all the markets, commodities and foreign exchange and stocks and everything else. But what I want to get across at the moment is I don't necessarily think this is going to go to 1.7 because I just don't see, whilst the base has been formed, pressure for it to move onwards and upwards. There. Sterling, Canadian, this is all over the place. And if I had to put my money on it, I would say this is going to fall. I'd rather be short sterling Canadian dollar than anything else. Not a strong conviction on this. I think it's going to ease lower to about 154 in that one over the next couple of months. Sterling Australian dollar, I would sell any price rises. Anytime this gets higher, keep it selling. In other words, I think this overall trend is intact. Despite some of the momentum looking like it's going to rise, I think the broader trend, which started in October 2010, is intact and still downwards. So that's my overall bias there. Similar with Euro Canadian dollar here, you can see view is very much still looking at a bias towards weakness and that falling further down there. What about sterling against the Singaporean dollar? I have said before, fundamentally I expect the Singaporean dollar to strengthen. The reason is, I've just come back from Singapore, the economy is still strong, they're going to raise interest rates, they trade a lot with China and of course Southeast Asia and Australia and benefit from that, they're a financial center, all of that is good news. And despite the Singaporean dollar having strengthened so much, in other words, this currency, this having fallen the direction of sterling Singapore dollar downwards, I think it will still continue strengthening. In other words, I still think this will continue going downwards. So Singaporean dollar likely to strengthen. In other words, this trend is to continue downwards. So I'd be looking to short sterling Singapore dollar. And then there's a lot of complicated jargon. Shorting it means it's going to fall, which actually means that the Singapore dollar is going to get stronger. Another way to look at it is that the first currency mentioned, pound, is going to get weaker. And that's why you short, that's why you think it's going to fall. The pound is going to be weaker against the Singaporean dollar because people will buy Singaporean dollars and push up its price, making it stronger because they're going to get better interest rates and the economy is growing better than the UK or relative to the UK. US dollar Canadian. Now this is a difficult one. I think short term, very short term, a bit of a fall before it stabilizes. The reason I say this is the shorter term momentum indicator like the stochastic is starting to move up. However, more important than that and of greater force is the MACD. So at the moment I'd be neutral on this. The reason, and at best expect it to fall only a tiny bit and stabilize. The reason I put it up, however, is because it's a very important pair, the dollar, Canadian dollar, US and Canadian dollar. So the US dollar against the loonie. Next. Sterling Norwegian krona. I don't want to bet against the Norwegian krona. In other words, I expect this trend to continue southwards. I expect the krona to continue strengthening. As I've already said, oil-rich country, one of the few which, if we did have readmission to the EU for everybody and they all had to apply again, well, Germany wouldn't make it, but the Finns would, and I think the Norwegians would as well. So would the, I think it's the Slovenians, would be eligible for EU entry. It's going to be a very funny union if they do ask everybody to readmit themselves. Next, Euro, Norwegian krona. Look, this is the point I'm making about the Norwegian krona. It is going to get stronger. In other words, the euro is getting weaker against the krona. It's got more to do with the strength of the krona than any worries about Europe. It's an oil-rich commodity currency, and that's why. It's not shown so well on sterling krona because sterling is considered a safer, stronger currency than the euro, of course. But if you look at it here, that tells you just how much stronger krona is against the euro, and why we're probably better off being outside the euro at the moment. What about sterling dollar? What about cable? Well, I'm actually neutral on this looking at the charts. I could argue for the dollar to get weaker, which I've done and mentioned already, and sterling to get stronger, and therefore to rise up and up. And if you look at the trend has been downwards, and we have argued for a weaker dollar as the expectation. But as I say, with the charts fairly neutral, with the fundamentals, yeah, I'd rather put my money on long cable. But again, I don't need to. I don't need to have a gun put to my head. The stronger trade is Euro Norwegian krona than cable, so why would I force myself to do cable? I beg your pardon. This is the weekly bars. So each one of these bars represents 1 week. Of course, none of this matters if we use the event trading strategy I showed you earlier, where we're just trading half an hour during the day. This is to give you a broader perspective for those who want a broader term trade. What about euro dollar? You can see it downwards. Despite some appreciation in this currency, in other words, the euro having strengthened this year so far, I still see it going lower, and that's because the MACD, the momentum indicator there, is still showing weakness. So that's what I'm expecting, is the euro to continue its downward move against the American dollar. This is one of the easier trades, Swedish krona and Norwegian krona. You can see I put the arrow in the direction, and the MACD is rising so stochastic, and that's why momentum is taking it that way, and that's the direction for the moment I see in that. So a pretty straightforward one. Similarly, sterling euro. What about that then? Well, again, picture quite clear to me, which it is. I apologize. Let me just go back to that trade. I'm seeing the momentum in the direction of the arrow, which means I see sterling being stronger and stronger against the euro. And it already has appreciated significantly, but that's where I put my money. You might get the odd down move, and these are 1 month bars. Each one of these bars represents a 1 month move in the currency, but over the next 3-4 months I would be expecting the euro to weaken because momentum is in that direction. Swiss franc, Norwegian krona. This is a slightly easier trade. I see the fall off in the MACD, and therefore I'm expecting this price to dip downwards. I'm expecting the Swiss franc, therefore, to weaken against the Norwegian krona. As you've seen, I've been very bullish about the krona against virtually every currency, and this is no exception. Okay, that's some of the predictions. I'll give you the predictions of Goldman Sachs for the year ahead and the figures they've put a little bit later. I want to give you another little snippet of what private investors do and who makes money, who doesn't. I said there's a dedicated webinar for that, but for now, I just want to give you one small snippet of that as we wrap up and in the final 10 minutes. This is really important. This could make the difference to whether you make a lot of money or not. This shows the profitability by time frame for the top 5 traded currency pairs. So you see the graph shows dollar yen, cable, dollar Swissy, Australian dollar, US dollar, euro, dollar. And it shows on there the profitability based on hour of the day, New York time, so we're 5 hours time difference there, between midnight and 1 a.m. all the way to 2300 hours to midnight, when private investors who are trading, when they're the most profitable and in which pairs. So you can see the probability of profitability is quite high if you're trading US dollar, Japanese yen at around midnight US time. And also if you're trading sterling dollar around, well, from midnight to about 5 a.m. US time. Bottom line is, don't, whatever you do, trade euro dollar between 9 a.m. US time, which is 2 p.m. our UK time, and about, well, I'd say about now UK time, now US time, 8 o'clock US time, which means about 1 a.m. UK time. And guess what a lot of private investors do? They trade exactly euro dollar between those hours. So this tells you when you should trade, or rather who your peers, private investors, are making most money in. You can see cable is pretty even actually over there. You get a sharp fall off in some of the other currencies and probability of profits decreases. But for cable trading sterling euro, you're looking at that. This ties in nicely with the earlier chart that I showed you of which trades are you most likely to be profitable in and which ones do private investors actually make the most money in. So this tells you then which ones you should trade, where you're going to be most profitable, by what time of day. Again, it's all about putting little edges in your way, just making sure you've got little advantage, just some more odds in your going. That was spread betting, that previous one. This is foreign exchange through this account, alpeshb.com/live. Similar kind of thing. I want to buy, I want to sell. And if your position size, and he'll go into all of these explanations, is $10,000. Doesn't mean you put $10,000 into your account. What it means is you have $50 in your account. And because of leverage, the way the foreign exchange markets work, it's the equivalent of having $10,000 in your account. And every time one of these moves a point, you make $1. So if you had a $10,000 notional position size, i.e. $50 in your account, and clicked on buy, and it moved up 1 pip, you would get $1 in profit. Now that all sounds incredibly complicated. It's very easy once you start doing it, and Paresh will go through all of this and what all these things mean, these numbers and how it all works out, and so on and so forth. But once you do one, it's so easy. So as I said, live accounts, if you want to give it a shot, have a look. We chose FXM as the partner, so if you open an account, ping me and I'll send you all that free stuff. And the reason we chose them as a partner is they don't have dealers. So basically they have a collection of banks who are going to give me my prices, and it's what's called a blind agency. Those banks don't know whether I'm looking to buy or sell. This broker is not taking a bet against me. They don't do proprietary trading, they just do it straight through. And because there's multiple banks competing for prices, I can pick and choose. I'm not just stuck to that one broker's price, which could move against me. And some brokers are known to manipulate prices accordingly. And so I want one which has got, as I say, a blind agency where they don't know whether I'm buying or selling, and it goes into the broader market, and they can't pick off my stops or my limits or my entry orders because they don't see them. This slide is one of the kinds of things which, as I say, Paresh will be explaining in terms of basics, what all these things mean in greater detail. So I won't need to, but it's a sort of a teaser to that, and how you buy, how you sell when you click a button. I think we're going to do live trades. So let me give you some of the broader trends and where they're going, and resistance and support levels for every single symbol. You will want to pause this once we give you a link to this video, because I'm not going to obviously read every single number. But if you're interested in euro sterling, then you'll want to know these are the supports, and the broad trend at the moment is sideways, and so on. For each one of these are Forex supports and resistances and support levels, whether the supports are weak, moderate or strong. So if it's a strong support, you know that when a support is hit, to buy off it. Again, Paresh will be talking about what supports and resistances are and how you trade them, but I wanted to give you all of these figures. You might, as I hit pause and write them down, or press print there. That's the consensus figures from Bloomberg of all the major currencies for the year ahead. End 2012, this is where they think all the major banks, including Goldman's and Merrill's and all the rest of them, where they think these currencies will end up by the end of 2012. The reason that's important, and this is the spot price, so that's the current price, where they think, that may, if you want a longer term trade, you might think, ooh, Euro Norwegian Krona is going to go from 69.22 to just 54. Yeah, I think I might want to get in on that now, because that's quite a big drop. And whereas with others, which are, let's say, not necessarily going to move much, you might say, you know what, I'm going to leave it. I don't want to necessarily make a longer-term trade on those ones. So I wanted to let you have that. Like I say, we're going to email you all so that you can get access to my blog, which means these kinds of images will appear in your inbox once a day of what I'm trading and what strategies I'm adopting, what I think is going to happen in the markets, and it'll just come in your inbox. But we'll do all that for you. We'll send you an invitation, and accept it. You'll get that in your inbox for free every day because I like talking to people. In future seminars, I'm going to talk about strategies like this one, this is euro dollar, and how actual traders trade this, and this is an example of one account, and these are real profits. At the bottom you can see the profits, and these are all the trades. So on trade, for instance, 260, £500 was made, and essentially 454 trades were done, 450 of them were winning. There were 4 losing trades, which were down here. You can see anything over there, and all the other smaller ones are just finance charges, the overnight cost of trading on margin, which is where the brokers basically lend you the money and charge you interest for lending it to you. But what you can see is these are the kinds of strategies that we're going to look at, because this was what happened. One of them followed our strategies, and these are actual live results that they did. It was actually using this strategy. So in a future seminar, when we go through strategies, well, we'll be able to actually show you live results, what actually happened. This was a particularly good period, 1st to 17th of July. It was a pretty long period, given that it's tested on 500 trades. It wasn't that we got lucky, it's just that we picked that period because it was just kept on going. Great, done. So as I say, upcoming webinars, and you'll find all of those if you go to alpeshb.com/webinars or just alpeshb.com and sign up, and we'll also email you those anyway. But some of them are Who Makes Money Trading FX, How to Read the Charts, and my monthly outlooks, and we'll put the dates up.